Okay, so I'm gonna give this a shot. Not really sure how this is going to unfold. It's the first time I've ever done this in my life. So my idea here is that every Friday at approximately, I think in the US it's 8 a.m. Eastern time, I'm going to be talking about investing. And really it's a place where it's really aimed mostly at beginners, for something that investors are kind of looking about. They're kind of getting started, or they kind of want to find out some questions about, let's say, what kind of books to read or how to think about valuations and growth versus value. So it's really a place for you just to kind of pop in, drop a few questions. Kind of going to run it a bit like Twitter Spaces. So with that aside, I'll just kind of get into a few questions that came in before I kind of got started today. So if you have any questions that kind of interest you, just feel free to drop it into the chat and we'll see how it goes. So one of the questions that I get asked quite a lot is how much accounting do you actually need to know how to invest? And you'll be surprised, but you actually don't know. You don't actually need a lot of accounting. So what you need to figure out and you need to kind of understand is that you need approximately, let's say, to understand how to operate a cash flow statement. So you need to kind of understand, that's the most really important thing, because everyone knows how to think about, for example, revenue and stuff like that, but you need to think about the cash flow statement. So I would say that's really the most important thing. There's a great book called Creative Cash Flows, and that's the one that I would say spend some time on. It's a bit dense, a bit difficult, but that's the one I would say figure out the cash flow statement and then work from there. So for example, the cash flow statement has three parts. Has cash flow from operations, which is what everyone is kind of looking out for, but then below that there's cash flow from investing. And in the cash flow for investing, that's really where the thing that management doesn't want you to pay attention to is they hide the kind of stuff. So let's say acquisitions that kind of get snuck in there, or for example, if you're looking at intangibles being acquired, or those kind of things, So that's the kind of thing that I would look at. So I would look at the cash flow from investing, and then I would look at just to see what's kind of the big items there. You don't need to kind of get caught up in small little things, but that's the real big things. Just subtract that out from cash flow from operations, and you end up with free cash flow. So you just want to get a sense, because I'm a value investor, and as Jeff Bezos says, that's the biggest predeterminant of the valuation is growing free cash flow over time. So I think that in essence, what you want to think about is the company's ability to grow free cash flow over time. So you want to see a business grow its free cash flow per share over time. Make it even better, you want to have a high free cash flow margin. So it's just taking the free cash flow divided by revenue. So typically, if a business has, let's say, a free cash flow margin of approximately, let's say, 5%, that kind of is an interesting investment. And if it kind of gets closer to 10 or whatever, that's probably even better. If you are able to buy those without paying a silly valuation, that's something that's really kind of quite attractive. So the other question that I get asked quite a lot is, when we think about building a portfolio, what's a reasonable amount of stocks? So this, for everyone that you're going to ask, you're going to get a different answer. And what I will say is that you got to start thinking for yourself. But ultimately, I believe that somewhere between 8 and 15 stocks is a rounded enough portfolio. For some investors, that's very, very concentrated, and I get that. If you're kind of a certain age and you don't want that to deal with that volatility, I get that. So you kind of maybe would inch up to 12, 13, 14, but much above that, you're going to struggle really to follow those companies. When you get to, let's say, 20 stocks, what happens then is that you're just in your mind just seeing those ticker symbols, and it becomes quite difficult for you to actually follow the story. You can't know a business, you can't know 20 businesses. It's just difficult to know 20 businesses. The example I think all the time about is, if you are buying a business, you're buying like a house. When you buy a house, you do a lot of due diligence. So you go around the neighborhood, you spend a bit of time thinking about what kind of house you're going to buy, and then you try and do some kind of valuations and try and figure out, okay, this house is more expensive, yes, but it's in a better location. That house is cheaper, has a broken door. Maybe they can repair the door, and then over time that door gets repaired and it appreciates in price. So those are the kind of thinking that you need to do. Now, you can't do that for 20 companies, and there's no way that your 20th idea is going to be any better than your first 1, 2, 3, 4, 5 ideas. I mean, always, whenever possible, go for the investments that you already know, and go, more importantly, for investments where you're less likely to lose capital. That's really the goal, really. You want to try and be in a position where you are just really not going to be losing capital. So you want to make investments where the likelihood of you losing capital is really, really small. Peter Lynch has this quote that going for long shots become no shots. So it's really about you trying to deploy capital, not for the highest rate of return, but for the likelihood of you losing capital. So you want to position size that out. So what does that mean, position size? So when you're looking at a portfolio, you kind of have, let's say, your first 5 or 8 ideas which you have stronger conviction on, and then you have smaller positions, right? Now, those bigger positions in the, let's say, 5 or 8 positions, you don't want to be deploying into things, if it goes up, I'll make like a lot of capital. You want to be in a position where you are deploying capital where you're less likely to lose the capital. So you want to be deploying into businesses that, if possible, has management that is strongly aligned with you. So you want to see management have skin in the game, because when the share price goes down, you know that they are also suffering. So you want to be aligned with management has a lot of skin in the game. You want to be aligned in a business that is growing over time. By growing, I mean it needs to be growing its revenues. Margins need to be stable or improving, and ideally you don't want to see that the number of diluted shares increasing too much. So that's another question that I get asked quite a lot. When you look at free cash flow, that means that management is adding back stock-based compensation. And what I respond to that is that if you think about it, historically, when you were building a business, it was capital intensive. You had to have a lot of, let's say, stock-based compensation. You had to have a lot of capital expenditure to grow the business out. So, for example, you were building a factory. That's very capital intensive. So that capital would go towards, let's say, the likelihoods of you building that out, but then that goes as capex. So the earnings that you're getting, let's say 50% of those earnings were redeployed back into the business. So the actual free cash flow that you got was nearly close to half of what the earnings were. Now, in the present economy, all these businesses are asset light, but management has to invest significantly into their executive team. They need to kind of round it out. They're not going to get some kind of Silicon Valley guy to get in, or girl to get in and do a lot of coding, and they want to get paid. Now, that's not such a bad thing. First, because it aligns everyone up and down the company with the share price. So that's good. That's the first thing. The second thing that I wanted to say is that when you look at the market cap of a company, that already takes into consideration the total numbers of diluted stocks. So if a company is diluting a shareholder quite significantly, yes, okay, they're diluting themselves, because if you're aligning yourself with management that has a lot of skin in the game, so they're diluting themselves. Secondly, you also have to think about that the market cap already factors in all that stock-based compensation that gets exercised over time. So it's not such a bad thing to have a lot of stock-based compensation. No, any idea taken to the extreme is obviously bad, but that's something that I would say, think about how much management has skin in the game relative to how aggressively they're diluting out the shareholders. So I see that there's a few people already kind of in the chat room. If you want to drop in a question yourselves, feel free to drop in a question. Another thing that I get asked a lot is really how long should you really be holding a stock? Now, here's the question here. How best to see? So if you look at the cash flow statement and you look at cash flow from operations, so there are three parts to a cash flow statement. So in the cash flow from operations, if you look, for example, let's say just for round numbers, that in the case of, let's say, Twitter for the year, they make close to, let's say, 900 million of cash flow from operations, but they're only spending approximately 200 million in stock-based compensation. I would say that's quite reasonable, okay? That, you know, they have to invest in their team. That's something that's okay. I don't want to mention by name, but I see other SaaS businesses where more than, let's say, what they make from cash flow of operations is stock-based comp. So the management, they're basically just using all that stock-based comp and kind of paying themselves out. So that's not what you want. You want to see approximately 30% more or less of stock-based compensation. You don't want to see too much more than that, because, you know, you need to get paid as well, you know. So that's one thing that, if you have any more questions, please do feel free to ask. The other thing that I want to talk about is holding periods. So how long should you really look to hold an investment? Now, in my mind, you kind of want to be holding the stock for at least, at the very, very minimum, a year. If you're holding it for less than a year, I mean, it's just a gamble whether it goes up or down. You want to be aligning yourself with the business over time. So you don't want to be holding it for, let's say, 10 years, because the world is getting too disrupted. So in 10 years, who knows what's going to happen, you know? No one could have predicted COVID, you know, what's going to happen in 10 years, nobody knows. You want to kind of hold it a medium period, I would say approximately 18 months or so to 2 years. Not too much, not too little. You kind of want to be in a position that you are participating in the company's prospects. So that's something that I think about, and people ask me quite a lot, is when do you know how to exit the stock, right? That's a really difficult thing. So it very much comes down to how you are as an investor. So the way that I look as an investing, I'm trying to buy things that are, let's say, slightly misunderstood today, so that in approximately, let's say, a year's time, when the investor's thinking about the next year, so they're thinking from 2 years out from right now, people are thinking to themselves, okay, wow, that's a good business. That's what I want to buy. I want to buy a business that people don't really 100% understand right now. So the valuation is compressed right now, but over the next years, people kind of increase their opinion of the business and the multiple expands. Then I start to slowly exit that over time. So the way I think about it is that you want to buy into businesses that people don't want to buy right now. You don't want to be buying the same businesses. Everyone's, for the sake of discussion, everyone's buying XYZ, and you don't want to be the same, you know, buying XYZ as well. You want to be buying something that people don't really want right now, with the idea that over the next, you know, year and a bit, people will come around and say, actually, you know, I got that business wrong, or a new bunch of investors look at that business and say, oh, that's actually a really solid business, and that's what I think that makes for a good investment. Is it better to add to Upstart or Affirm, or should I add to a newer stock such as... well, that's a really difficult question to answer. So I personally think that, you know, I'll just put it out there, that Apps and Fubo are probably some of the better investments, not necessarily because of that they're going to grow the fastest, just because I believe that at their valuation, I think that they make the most amount of sense. So this is the thing. Whenever it comes to investing, you really want to be in a position that thinking about the valuation, because in the case of Upstart, for example, it's a great business and I'm very much bullish that company, but as I said just a few seconds ago, you want to be buying what other people don't really want to be buying. So I did buy something here, you know, it's grown quite a bit, and I haven't, you know, I just keep it like that. But I think that in the case of Apps and Fubo, you look at their share price, man, nobody wants to get involved with those companies. Like, you look at Upstart, it's like everybody wants to get involved with that company. So what you do, if you want to buy, let's say, into Affirm or into Upstart, you put, let's say, 2% of your capital right now, and you kind of just say, okay, I'm going to just see how things develop, because in 30 days the market will be totally different and things will be collapsing, and you can buy another 2%, and then you got a 4% position. And you just want to try and kind of be very, very cautious on the approach. Always think about not losing capital. Always think about, okay, I'm going to go in really slowly. I buy a little bit. So imagine hypothetically a miracle happens and Upstart goes up another 50%. You're gaining a bit and you're quite happy with that. But you don't want to be chasing the stock too aggressively. So you kind of want to be really, really careful. So I think that in the case of Apps and Fubo, I think that makes a lot more sense to me, because nobody wants to get involved with those companies. And typically when people don't want to get involved, that's normally a good time to start buying into those companies, because as I said before, in 6 months' time, things will be totally different. For example, Fubo is a stock that I'm very bullish about, and everyone is like saying, okay, Fubo is unprofitable, the margins suck, and people saying, oh, Fubo will never be a reasonable investment. But I'm thinking myself, okay, so Fubo has three parts. Fubo has the streaming business that sucks, everybody knows, management knows it sucks, everybody else knows it sucks, okay? So that's approximately 80% of the business. Then they got this other part of the business, which is advertising. That right now, I think going into Q4, I estimated that approximately 15% of Fubo is going to be coming from the advertising business. The advertising business is actually growing at a really rapid rate. So if you think about it, where you're going to get, as an advertiser, be able to get the demographic of 18 to 54-year-olds, a highly concentrated people with capital, because remember, in the case of Fubo, people are already paying around $64 per month just to get Fubo. So it's not people that have no capital, it's people that are already paying for a subscription, so they're already accustomed to spending money on your platform. So you get a very tight cohort, a very tight demographics, and that's exactly what advertising wants. And you can see the advertising business is running at approximately 200%. So you get that. The advertising business is small right now, but that has it's just so strong. I mean, I don't want to kind of say like exaggerated numbers, but it's not inconceivable that over the next year it might even continue to grow at, let's say, 60% year over year. I mean, it's not impossible. So you get the advertising business with a very high margin. You look at any advertising business and the gross margins are approximately 55 to 60%. So you get a very high gross margin business growing at approximately, let's say, 60% thereabouts over the next year. And then you got the streaming business as the bulk of the business that everybody knows. And then you got the betting business, which is this kind of wild card, as I call it, because that's really not priced in. If you look at, let's say, DraftKings, and you look at the margin that DraftKings has, gross margins of 40%, and you say, 45%, and you say that Fubo's going to come in and, they're not as good at it, they're kind of up about around 35% or thereabouts, you're already coming up to what Netflix was doing approximately 10 years ago. So you're already kind of coming in and you're already thinking to yourself, okay, so the story is developing so quickly that over the next 2 quarters, people are going to be like, oh, Fubo is a betting business. And it's going to be, I think that there's going to be a re-rating of the stock right there. So I don't really remember KPLT, I don't really know that one. If that's like Sophie Technologies, I don't really know. But I mean, a firm is like a leading company on its own. There are always going to be competitors. You look at, let's say, PayPal with their acquisition, their buy now, pay later. You look at Apple Pay. You look at the likes of Afterpay that was acquired by Square. So I think that competition is not something necessarily that you should be kind of saying, okay, oh, this competitors coming on board and that's going to disrupt everything. I think that just really validates the business model. The fact that everyone is trying to get involved. Remember, like with streaming wars, everyone's like, oh, there's going to be streaming wars. Nobody's going to have time to watch all these streaming channels, and it's going to be the death of Netflix. I think that yesterday, the day before, Netflix just hit an all-time high. So it's just competition actually, kind of gets a little bit blown out of proportion, and it very much happens towards the end of the business's maturity. It's when that the total addressable market has started to slow down its growth rates. That's really when competition makes a huge role. When it's so embryonic, the buy now, pay later solution, I mean, I don't think that it just validates. If anything, you look at the kinds of Catapult. Sorry, I didn't remember that name. Sorry. If you look at the likes of, let's say, a firm, and they just talked about, that's why the stock rallied a few weeks ago by 20%, because they kind of partnering up with Amazon. Now think about Amazon, right? Does Amazon want to put Apple Pay as one of its checkout options? Absolutely not. They really want to put out a company that is not going to give Apple any more market share. So they're going to go with the best of the best, because Amazon is very consumer focused, obviously, yeah. So the fact that they've chosen to go with a firm really just shows to me that that Amazon recognizes that it's really, really important to have buy now, pay later solutions. And what the thing that distinguishes a firm from probably the other players out there is that you have a lot more options in terms of how you pay out. You can have, not like in the case of PayPal, I think it's 3 months. That's the only option either to expand out. In the case of a firm, you can do it over, let's say, even a year. So it's just more options. And if you're going to be investing in technology, I make the case that it's more important to pay up slightly for a leading company rather than going for a second tier company and paying a lower multiple. It can work out, often cases it does work out. We've seen recent, this is a stock that I kind of follow, Palo Alto Networks. So Palo Alto Networks in the last 6 months is up approximately 70%, which is much more than CrowdStrike. So sometimes when you got, let's say, the second tier company kind of coming in, you do get that re-rating higher. But if you look at how before the past 6 months, how Palo Alto was lagging, whenever possible, you want to invest your capital towards the safest opportunities, and you want to try and go into the market leaders, but you don't want to be paying a crazy multiple too. So it's really important to kind of get that kind of thinking through, that whenever you deploy capital, go for the safest opportunity. If anyone wants to ask any more questions, I think there's a few more people now coming on board. I'm going to run this every Friday at approximately this time. I'm going to run it for about thanks for that answer. I'm gonna run it for approximately 20 minutes every Friday, and my idea is that people kind of want to find out some kind of things behind the idea. Why did I think about X, Y, Z? Sometimes don't have time to explain myself very much. Yeah, I don't really get involved in that kind of sector, Moderna and stuff like that. I mean, I kind of try and stick around if possible to this kind of tech space. I really want to be into businesses that have the potential to kind of really like just explode on the upside. I'm not trying to kind of find those slightly slower growth companies that everyone else is following. For example, if you look at anytime that there's like a news coming out of a biotech company that they've just kind of got some kind of approval, it immediately rockets up the share price, and then like 2 weeks later, oh, actually the approval didn't get really approved properly, and then the share price plummets again. I want to be investing in businesses that I know I can sleep well at night. And I want to be investing in businesses that are growing, and in the best case scenario, you don't want to be paying too much as well. So if anyone wants to ask any other questions, I'll just kind of jump around different topics. And the one thing that I want to talk about is that I was quite surprised when I looked through this. So when it comes to investing, it's so much more important to be able to stick with the investment than it is to compound at a high growth return. So I'll give you an example, real quick example. 1 second. So yeah, so in the case of Rent-A-Center, which is one of the stocks that I do own, Rent-A-Center is not really going to get crushed by like the housing market. It's not really the kind of business model. So the business model of Rent-A-Center is that they rent out furniture and stuff, and there's this whole movement right now, and it's not only Rent-A-Center, there are other players in the space as well that move into this model where it's kind of lending out stuff to lending out with the intention of buying to subprime customers that don't have a high FICO score. They sometimes are priced out of being able to take stuff on credit. So what Rent-A-Center has is Acima. Acima is kind of a rent-to-own payment provider. It's kind of fully digital, and it's not like, let's say, Affirm, because Affirm is looking for the best customers, okay? Acima, the default rates on Acima are much, much higher. It's a much lower credit-rated customer, and the likelihood of those customers defaulting is higher. So you're not going to be growing that as fast, but on the other side of the equation, you get Acima plus Rent-A-Center. So Rent-A-Center right now is actually slightly smaller than Acima. So Acima's kind of grown quite quickly, and Rent-A-Center is actually the smaller business. Someone was joking and said to me, I believe that Rent-A-Center is going to be renamed as the share price to Acima, just for Wall Street investors to kind of re-rate the stock higher, because Acima is like, kind of in the buy now, pay later solution, but it's not really. It's slightly different. But in any case, it's something that allows customers that don't really have another way of accessing credit, and allows them to pay over time. So you get a stock that's with Rent-A-Center is growing at, let's say, approximately 10 or 15%, but it's very, very cash flow generative. So you get this one part of the business that is really, really attractive, and then you got a slightly faster growing business, which is now going to overtake the Rent-A-Center business, and is actually growing significantly faster. So what management can do and is doing, they're taking the capital out of the Rent-A-Center business, deploying it into Acima, and you're getting some kind of free funding coming in that allows the company to grow at approximately 20% while being incredibly free cash flow generative. So you have this target for 2023 of reaching approximately 850 million of EBITDA, and they have a very high free cash flow conversion. So the share price right now is approximately, I think, approximately 4 billion. You guys can check when in your own time, and you're just paying such a low multiple for the stock, and it's a very safe investment because that's the kind of thing that I really like. I like those kind of investments where you're not going to lose a lot of capital. So if things kind of go slightly sour and they miss a quarter or something, there's just, you're paying approximately 1 time sales for this business that's growing approximately 20% year over year, and it's very, very free cash flow generative. And they have in the past repurchased shares too, and they have talked about that. So you're getting a very, very safe investment. That's really the kind of thing that I'm kind of really interested in. Let me just see if there's another question here. So another thing that people talked about is about sticking with how long should I be? Thank you so much. So essentially, one thing that I wanted to highlight is that about the difference between a high return on invested capital versus just sticking with investing. I'll give you 2 examples. Okay, let's say Investor A is compounding at 16% year over year. Okay. They put $5,000 down in year 1. After 20 years, growing at 16% compounded, that's 94,000. Okay, so that's great. You're like, yeah, that's great. Yeah, 16%. You've beaten everyone. You're the messiah. Okay. Investor 2 is not as good. Okay, so it compounds at 13%. So it's a step down. They know they're not as good, right? But every single month, on the first of the month, they put in $500. $500 is not that much, right, guys? And the difference, even despite compounding at a lower rate of return, is that investor makes $514,000 over the 20 years. So despite being not as good, you just a more human investor and just sticking with it for 20 years. 20 years not long. So I was thinking to myself, okay, so if my parents are in the mid 60s and they kind of start doing this right now, and they come out in the mid 80s, that's not the end of the world. Many people are living to late 80s, That's something that even somebody that is approaching 60 years old can really get involved with. And you don't need to stick around to year 20, but it's really when the magic happens in compounding, is really in that last period. That's how it is, But it's something that anyone can do, and I'm sure that people kind of coming on this video right now, they're way below 60. So that's something that I want to talk about. So yeah, if you have any more questions, so Sentinel or CrowdStrike. Well, I've never even heard of CrowdStrike. I mean Sentinel, so obviously CrowdStrike. So people say, just before I wrap up here, so people always say to me, oh, the market is higher right now. So the market has been consistently going higher for more than 100 years. So if you just kind of think about, the market can go up and it can go down. We've been, over the last several years, in 2018, we had the Q4 problem with Trump and the China crisis. Then obviously it got COVID. So people got over those problems and the market gets over those problems too. Every time that the market goes down, like in 2008, it goes through a period of, just getting rid of the wretched excess. And then, a year and a half later, it's back on, look at the dot-com bust, it was about a year and a half and then things kind of stabilized. There's always going to be these ups and downs, but the game that I want to talk about is just stick with investing, just stick with it for approximately 20 years, and make it a habit. So every, just on the first of each month, you just put into, and what I would say is try not to invest into storage stocks, trying to invest into businesses that are growing at a reasonable rate, you're not paying too much, and management is very much aligned with you. You don't want to kind of get what the people call mercenary management, where management comes in to kind of solve the problem and they're going to cash out in 5 years. So really try to align yourself into safe investments. Anyway, okay, I think that's pretty much it. I don't think there's many other questions coming in, and I'm gonna just keep it short and sweet so that you guys, can have your weekend as well. Okay, guys, thank you so much. I'll see you next soon. Bye.